Hello everyone. A wind of rigor is blowing through ESG labels and bonds, so let's have a look at that trend. Firstly, an analysis of ESG new issues in 2024 illustrates the trend. While volumes are up by 2.5% compared with the same period in 2023, 61% of these bonds are classic green bonds. Other bonds with similar format, which is investors know which project their funds will be allocated to, are also on the increase. And by contrast, sustainability-linked bonds, SLBs, where the issuer sets itself global objectives, are in free fall, with 58% fewer volumes this year. And the trend is the same in the market for sustainability-linked loans, SLLs, with volumes down 74%. New regulatory constraints, fewer financial incentives, and the risk of being accused of greenwashing are holding investors back. Some are worried about the new rules to be introduced by the FCA, the UK regulator, on the 31st of May. Although it is not the first to introduce safeguards, it is taking the pressure up a notch. The rules could affect not only borrowers, but also the banks that structure the bonds and other loans. So this is a form of shared responsibility to limit the risk of greenwashing. The rules would also cover documentation, communication, and even the use of images. As some say, it will be no longer possible to use a picture of a smiling orangutan against a lush jungle backdrop to promote a company active in palm oil production. The British regulator is not the only one to be on the front foot. The scandal affecting the SBTI reference label, following a haphazard change in methodology, and the mobilization of NGOs against Total Energy are other examples. The French giant had announced in 2021 that it would only finance itself with sustainability-linked bonds, SLBs. 3 years later, no Total Energy SLB has been issued, but early April, the group issued a conventional bond of $4.5 billion spread over 3 maturities, 10, 30 and 40 years. Some 60 NGOs called on investors not to subscribe because, among other things, it is the listed company in the world with the most short-term oil and gas expansion plans. The call did not have a huge impact, and with order books of more than $14 billion, Total was able to tighten the initial terms of its new bonds by 20 basis points. In other words, the group saved $230 million on interest charges. So, label or not label? In the end, that is the question. The conclusion of a Bloomberg analysis of the financing of companies mainly active in clean energy is interesting. 70% of the bonds issued by those companies are conventional bonds, and on the rest, the label mainly used is green bonds. And with more than a decade of existence and higher transparency, green bonds should confirm their leading role in this area. Thank you.